You're about to be shown two policies that look the same, but one of them could cost you over $200,000 in unnecessary fees. The industry calls it the great debate, term versus whole life. But I'm going to tell you the truth they never want you to hear. For 80% of people, whole life is an expensive trap. We're tearing up the sales pitch to show you the simple math that proves you could get the same protection, spend 15 times less, and be $50,000 richer by the time you retire. You need to watch this before you talk to an agent. The truth is, neither is universally right or wrong. The best choice depends entirely on your personal financial situation, your goals, and the specific problem you're trying to solve. In this video, we're not just going to list the differences. We're going to do a deep side-by-side comparison of term and whole life insurance. By the end, you will have a crystal clear understanding of which type of policy aligns with your life, so you can make a decision with total confidence. Let's start by building a foundational understanding of each type, beginning with the simpler of the two, term life insurance. Think of term life insurance as renting your coverage. You are purchasing pure, straightforward life insurance protection for a specific, predefined period of time, or term. Common terms are 10, 20, or 30 years. During this term, you pay a fixed, level premium. If you pass away during that period, the insurance company pays the full death benefit to your beneficiaries, income tax-free. It's a clean, powerful transaction. However, if you outlive the term, the policy simply expires. There's no payout. The coverage ends. Just like when you move out of a rented apartment, you get your security deposit back, but you don't get a piece of the property. The insurance company keeps all the premiums you paid. This is why term life is so incredibly affordable. You are only paying for the risk of you dying during that specific window, and the likelihood of that happening while you're young and healthy is statistically low. So what is the primary purpose of term life? It's for covering temporary, massive financial obligations. This is the perfect tool for your peak responsibility years. It's designed to replace your income if you die while you have a mortgage, while your kids are dependent and need college funding, and while you have other significant debts. You buy a 20 or 30-year term policy to match that period of vulnerability. Once the term is over, the hope is that your mortgage is paid, your kids are self-sufficient, and you've accumulated enough wealth in your retirement and investment accounts that your family no longer relies on your income to survive. The need for a large death benefit has disappeared. Now let's contrast that with whole life. Think of whole life insurance as buying a home. It is a form of permanent life insurance, meaning it is designed to last for your entire whole life as long as you continue to pay the premiums. The death benefit is guaranteed to be paid out to your beneficiaries, eventually. Because of this 100% certainty for the insurer, the premiums are significantly higher than for a term policy with the same death benefit. But the biggest difference and the source of most confusion is the cash value component. A whole life policy is a hybrid product. Part of your premium pays for the pure insurance death benefit, and the other part goes into a separate, tax-deferred savings or investment account within the policy. This is your cash value. This cash value grows over time at a fixed, guaranteed interest rate set by the insurance company. It is not tied to the stock market. You can access this money while you're alive by taking out a policy loan or making a withdrawal. This is often marketed as a living benefit. However, it's crucial to understand that any outstanding loans against the cash value will be deducted from the death benefit paid to your beneficiaries when you pass away. So, what is the primary purpose of whole life? It's for permanent needs and forced savings. It's suitable for someone who has a lifelong dependent, like a child with special needs, where a death benefit will always be required. It's also used for estate planning by high net worth individuals to help pay estate taxes. For the average person, its appeal as a conservative, forced savings vehicle with a death benefit attached. Now let's put them head to head in three critical areas. First, and glaringly, cost. For a healthy 35-year-old, a $500,000 20-year term policy might cost around $30 per month. A $500,000 whole life policy for that same person could easily cost $500 to $700 per month. That's 15 to 20 times more expensive for the same initial death benefit. The reason is simple. With whole life, you are prepaying for a death benefit that is guaranteed to be paid out, and you are funding that internal savings account. Second, duration and long-term value. Term life is temporary. It solves a specific time-bound problem. If you outlive it, you get nothing back, but you had affordable peace of mind during your most vulnerable years. Whole life is permanent. You will never outlive the coverage. You are also building equity in the form of cash value, but it comes at a very high upfront cost. Third, flexibility and complexity. Term life is simple. It's pure insurance. Whole life is complex. It involves understanding dividends, which are not guaranteed, loan interest rates, and the policy's internal costs and fees. It requires a long-term commitment to see the cash value accumulate meaningfully. So, who wins? The answer is entirely situational. Term life is the undisputed winner for about 80% of families. If your main goal is to replace your income during your high obligation years in the most cost-effective way possible, term life is the perfect, efficient tool. It allows you to get the maximum protection for your premium dollar, freeing up the rest of your budget to invest elsewhere, like in a 401k or IRA, where the growth potential is often higher and more flexible. Whole life can be a consideration for a much smaller group. If you have a permanent need for insurance, if you are already maxing out all your other retirement-exempt accounts and are looking for another conservative savings vehicle, and if you fully understand the cost and complexities, then whole life might have a place in your overall financial plan. The biggest mistake people make is buying an expensive whole life policy when they really just need a large, affordable term policy to protect their family's immediate future. They end up severely underinsured because they couldn't afford a large enough death benefit. In summary, choose term life insurance if you have a temporary problem, protecting your family's standard of living while you have a mortgage, debts, and young children. Choose whole life insurance only if you have a permanent, identifiable need for a death benefit and have already exhausted other more flexible investment options. Your mission is to match the financial tool to the problem you need to solve. Don't buy a complex, expensive, permanent solution for a simple, temporary problem. Now you have the knowledge to choose wisely.